Hello and good morning. Today my team will present the subject of TPA 30073 Cost and Management Accounting 1. Our lecturer Puan Nuraini and my team 01 DAT20F1008 Shafinah Binti Muhamad Fuzi. Next myself 01 DAT20F1010 Azani Binti Abdul Halim. 01 DAT20F1013 Zulaikha Binti Muhammad Zaki. 01 DAT20F1015 Syadiyah Binti Basree. Last 01 DAT20F1017 Shafinah Binti Mustafa. We from class DAT3A. Table of Content 1.1 Explain the concept, principle, methods and techniques of cost. 1.01 Define the cost accounting, present by Azani. 1.12 Explain the importance of cost accounting to management, Syazana. 1.13 Outline the difference between cost accounting and financial accounting, present by Shafinah. 1.14 Discuss the basic concept of costing principle. A. Cost unit, B. Cost center, C. Cost object, D. Cost conversion cost, will present by Zulaikha. Opportunity cost, incremental cost, replacement cost, will present by Shafinah. Sunk cost will present by Syazana. Next, 1.2 Detail the calculation of the cost accumulation and cost assignment. 1.2 Describe the accumulation and assignment of cost of different functions, present by Azani. 1.22 Explain cost accumulation for the purpose of stock valuation and profit reporting. A. Product cost, B. period cost, present by Syazana. 1.23 Discuss the cost accumulation for the purpose of decision making by using high-low method. A. Fixed cost, B. Variable cost, C. Semi-variable cost, present by Syazana. Present by Syadiyah, 1.24 Explain cost accumulation for the purpose of planning and control. A. Controllable cost, B. Non-controllable cost, present by Syadiyah. Now, let me tell you about define the cost accounting. Cost accounting is the establishment of budget, standard cost and actual cost of operation, processes, activities and products, and the analysis of various profitability of the social use of funds, CIMA standard. Cost accounting is a quantitative method that accumulates, classifies, summarizes, and interprets information for three major purposes. 1. Operation planning and controlling. 2. Special decision. And 3. Product decision. Charles T. Hungry.
Next, I will present about importance of cost accounting. Firstly, the importance of cost accounting is ascertaining cost and guiding selling price fixation. Price determination involves various factors such as the quality of the product, the market condition, and so on. Secondly, facilitating planning. Planning is a process that begins with the selection of the organization goals and objectives. It can be divided into two phases, strategic planning and operation planning. Both planning phases involve long-term planning. And next, facilitating controlling. The goal of the controlling process is to make sure that the work is completed to the specification and plans of the firm. Improvement of this process is achieved through cost accounting. Lastly, providing information for short-term and long-term decision making. A cost accounting system helps decision makers make informed decisions by providing them with accurate and up-to-date information on the cost of various activities. This process helps them identify profitable and unprofitable activities.
These are the differences between cost accounting and financial accounting. The first one is definition. For cost accounting, the classification, recording, presentation, and interpretation of the cost involved in the manufacturing and selling of each product, job, and service. For financial accounting, the analysis, classification, recording of how financial transaction and the ascertainment of how such transaction affect the performance and financial position of the business. The second one is objective. For cost accounting, the uncertain and controlled costs and maximize efficiency. The main purpose is to provide cost information to the management. For the financial accounting, the main purpose is to prepare a profit and loss account and balance sheet for reporting to outside parties. The third one is focus user. Focuses on the reporting to internal users of how accounting information such as managers. For financial accounting, focuses on reporting to external users of accounting information including investors, government regulators, shareholders, creditors, banks, and suppliers. The last one is format. No specific format focus accounting reports. They are prepared in the format decided internally by the firm in the format which must suit the users. For financial accounting, the financial statements are prepared in the format prescribed by regulator bodies.
Then I will present about the basic cost concept of costing principles. The first one is cost unit. Cost unit is a quantitative unit of output or service to which cost can be related. The unit chosen is what is most relevant for the activities of the organization. Within a given organization, there may be several different cost units in order to cost various products or activities. For example, per kilowatt hour, per kilogram of material, per passenger mile, per liter of paint, and per ton of cement. Okay, next I will explain about cost center. Cost center is a location, function, or item of equipment in respect of which cost may be ascertained and relate to cost for control purpose. Costs are gathered together according to their incidence. The gathering together of the indirect costs results in the establishment of the overhead relating to each cost center, which is essential to spread overhead over cost unit. Next, the importance of cost center. Firstly, helps in creation of responsibility center. Secondly, increase the operational efficiency. There have two main types of cost centers. The first one is cost centers related to production, and second one is cost centers related to provision of services. After that, example of cost center. Firstly, location. As example, sales department and sewing department. Secondly is person like salesman. And the last one is equipment like delivery van. Okay, now I will move to the cost object. A cost object is anything for which a cost is to be calculated or that makes you incur a cost. It could be anything for which a company plans to calculate costs separately. A cost object could be a part of the process to come up with the pricing of a product or service,
or it could be a spirit task to find the cost for the cost object. For example, product or service offered is a cost object, but if cost is calculated for a department, then the department becomes the cost object. Usage of cost object. Firstly, it helps to find the money it is spending on the object. Secondly, helps in managing and controlling the costs. Thirdly, helps in preparation of annual report. They have three types of cost object. Firstly, output. Secondly, operational. And the last one is business relationship. Okay, next I will present about conversion cost. Conversion cost is the cost incurred by any manufacturing entity in the process of converting its raw material into finished goods capable of being sold in the market and usually includes total variable costs and other applied overhead like factory overheads and administrative overhead. Some examples of conversion costs is machinery depreciation, plant and machinery maintenance, utility bills, and many more. The importance of conversion costs. Firstly, useful for calculation of cost of equivalent units. After that, helps in identification of wastage. And lastly, it is also time-saving method. Okay, next, the formula of conversion cost is manufacturing overheads plus direct labor equal to conversion cost.
I will continue for opportunity cost. What is opportunity cost? Okay. Opportunity cost means the cost or price of the next best alternative that is available to a business, company or investor that has been foregone and not been chosen. Importance of opportunity cost. The first one is production. It enables manufacturer to decide what to produce. The second one is investing. Opportunity cost of investing in house, land to avoid paying rental may be necessary factor for every business or individual. For example, go to a vacation now or save the money to invest in a house. There are two formulas for opportunity cost. The first formula is total revenue minus economic profit. The second formula is what on sacrifice divide what on gain. Next is incremental cost. Incremental cost is the total cost incurred due to an additional unit of product being produced. Incremental cost is calculated by analyzing the additional expenses involved in the production process, such as raw materials for one additional unit of production. Companies can use incremental cost analyzing to help determine the profitability of their business segment. Analyzing production volume and the incremental cost can help companies achieve economies of the scale to optimize production. A company can lose money if incremental cost exceeds incremental revenue. Incremental costs help to determine the profit maximization point for a company or when marginal costs equal marginal revenue. If a business is earning more incremental revenue per product than the incremental cost of manufacturing or buying the product, the business earns a profit. Alternatively, once incremental cost exceeds incremental revenue for a unit, the company takes a loss for each item produced. Important. Incremental cost, also known as marginal cost. Next is replacement cost. The replacement cost is an amount that a company pays to replace an essential asset that is priced at the same or equal value. The cost to replace an asset can change depending on variation in the market value of components used to reconstruct or repurchase the asset and other costs needed to get the asset ready for use. Company looks at the net present value and depreciation cost when deciding which asset need to be replaced or whether the cost is worth the expenses. To make a decision about an expensive asset purchase, company first decide on a discount rate, which is assumption about a minimum rate of return on any company investment. The cost of replacement and asset can change depending on variation in the market value of the asset and other costs needed to get the asset ready for use. Look at the picture that his replacement cost. Present value of machinery is $1,000. Replacement cost for that machinery is $2,000.
Lastly, the basic cost concept of costing principle is sunk costs. Sunk costs are referred to money that has already been spent and cannot be recovered. In business, sunk costs are typically not included in consideration when making future decisions, as they are seen as irrelevant to current and future budgetary concerns. Sunk costs are in contrast to relevant costs, which are future costs that have yet been incurred. For example, a manufacturing firm may have a number of sunk costs, such as the cost of machinery, equipment, and lease expenses on the factory. Okay, the minimize. Firstly, a predict a review of the investment and its benefit can fetch better result. Okay, next, recognizing sunk costs early rather than building up the losses. After that, constantly keep in mind the target that you will set while starting the project. And lastly, considering other available. The example of sunk costs is marketing study, research and development, hiring bonus, and training.
Different functions of cost accumulation and cost assignment. Cost accumulation to collect all costs, total cost of the product or service. Next, the use of a formal cost accounting system to collect cost information. Lastly, cost accumulation system falls into two main categories, which are job cost system and process system. While cost assignment, the identification and attachment of costs to the respective cost driver. The application of cost to the activity or object that triggered the incurrence of the cost. Lastly, cost assignment is also known as cost allocation.
Okay, I will present about cost accumulation for the purpose of stock valuation and profit reporting. The first cost accumulation is the product cost. Product costs are costs identified with goods produced. Product costs are initially identified as part of the inventory and include all costs that are involved in manufacturing a product. Element of product cost. Cost element: direct materials, direct wages, direct expenses, prime cost, production overhead, and total product cost. Next, the cost accumulation is period costs. Period costs are costs that are deducted as expenses during the current period without ever having been regarded as a part of inventory. Period costs are also called non-manufacturing costs and include all costs that are not part of product costs.
Cost accumulation for the purpose of decision making by using height-law method. So what is a height-law method? Height-law method is an accounting technique used to separate out fixed and variable costs in a limited set of data. It involves taking the highest level of activity and the lowest level of activity and comparing the total cost at each level. So the height-low method is used to separate fixed and variable costs. So what is a fixed cost? Fixed cost is those expenses that remain unchanged regardless of the quantity of item you produce for sale. For example, the rent you pay on the production facility will be the same whether you produce one cell phone case or 1 million case. Based on the logic, you will rather get the most of your money by producing the highest number of cases and reducing the average fixed cost per unit. It means fixed cost is remain the same number. Okay, how about variable cost? Variable cost is will change depending on the number of unit you producing. Unlike fixed cost, as we know, it will remain the same from begin until the end. Variable cost will increase when producing more unit and decrease when you produce fewer. Some example of expense that will be included in your variable cost are the material is plastic, rubber, glue, etc. Needed to produce your cell phone cases, shipping costs, and possibly direct labor to assemble the product. So how about semi-variable costs? Semi-variable costs have an element of both fixed and variable costs. To calculate the fixed and variable split of semi-variable costs, you can use the height-low method. To use this technique, you need to know the semi-variable cost for at least two different activity levels. So cost accumulation for the purpose of planning and control. So as we know, any organization have their own risk. There's something that we can control, then non-control, and same as the cost accumulation. So what is controllable cost? So when evaluating the performance of an executive or manager under managerial accounting, it is helpful to recognize that some costs and expenses may be out of the control of the manager or executive. One example is the manager's salary. The manager has no control over his own salary and has no power to change or stay within the budget for the salary. Controllable costs are things the executive, manager, or department even can control or change. Okay, how about non-controllable costs? This is something that we cannot control because of the few problem. So what is that? It is if the executive, manager, or department cannot change or control the cost, it is an uncontrollable cost. An example of uncontrollable cost would be an allocation of administrative expenses to each job or department. So this is an example for the controllable and uncontrollable that managed by restaurant manager. For the cost item, cost of food used in a restaurant can be controllable by the restaurant manager, while the cost of national advertising by a restaurant chain cannot be uncontrollable by restaurant manager.